What is a public offering? Or more specifically, what is the offering of an ownership interest in a business for sale, generally and openly to the public? Well, there are a couple of types of public offering. Probably the most well-known is the IPO, or the initial public offering. This is generally done with the assistance of underwriting firms and investment banks. The direct public offering is when a company goes through the process of selling its shares to the public at large, but does so itself without the help of an underwriting group, that is, that group of investment banks. Okay? Either of these scenarios is marked by the registration process. That is, you must register with the United States Securities and Exchange Commission prior to selling your ownership interest to the public. The SEC seeks to protect consumers, that is, investors out in the marketplace who might purchase an ownership interest in a business, by making certain that all applicable information has been disclosed to them so that they can make an educated and well-informed decision. So the registration process generally means filing extensive documents and disclosures with the Securities and Exchange Commission so that it can be made public through the Edgar search database on the SEC website to the public. And in that way, analysts can analyze the stock, identify valuation principles, things like that can be used by the public when making a purchase decision. The registration process is very arduous. It requires tons of effort, time, information, and services from accountants and legal professionals. So it can be quite expensive to undertake this process. But more importantly, it has to be carried out with precision in order to avoid legal liability potentially falling back on the firm that's issuing the public shares or to third parties assisting that firm with that process. Okay, so with a direct public offering, the firm is going to sell directly to the public, perhaps list their shares directly on an exchange for sale, and there are exchanges or stock exchanges out there that will facilitate this process, but whereby you're selling directly to the public. So anyone out there who wants to purchase an ownership interest in the company can do so, and it's doing so directly as the company sells the shares into the public market. Okay. In an IPO, you use the services of an underwriter. That is, the company doesn't actually sell directly to the public. They sell the shares or use underwriters, which is a group of investment companies, investment banks. The investment banks actually create some level of commitment to either purchase all the shares being sold by the company and then resell it to third parties, or to make their best efforts to act as agents to sell through them to third-party investors to get those shares out there into the public. A firm commitment is known where the investment bank is going to purchase all the shares being sold at some discount, and then they'll sell it to third parties at a higher price. Okay, a standby commitment is whereby if the company, if the investment group, if the investment bank is not able to sell all the shares to third parties, the bank will actually purchase the shares and then later resell those on the public market. And then a best efforts commitment is simply the commitment that they'll use their best efforts to try to sell all the shares of stock in the company, but if it doesn't sell, then it doesn't sell. There's no commitment there to purchase or otherwise buy any shares that don't sell. Okay, but what the underwriters do is they go on what's called a roadshow. They have investors that commonly invest in assets that these groups sell, such as private equity funds or mutual funds or endowments or high net worth individuals or other types of money investment funds, and they go to these funds and pitch these assets for sale and try to execute a sale to these third parties. And it's through these third parties, when they later resell the stock out on the public market or on public exchanges, this is when there is, once again, a market created for these assets. Okay. Now, as part of the process, the underwriters will facilitate the actual registration of these equity interest to be sold on particular exchanges to create that market so that the shares can be resold. Because generally an exchange like the New York Stock Exchange or other famous exchanges out there, you have to apply to and register to sell your ownership interest there, and you have to meet all the requirements of the exchange as part of that process. Okay, so this is generally what the initial public offering process and the direct public offering process is. In summary, you are simply selling your interest to the public after registering to sell that interest with the SEC and going through the registration process. Direct public offering, you're not using the services of underwriters, where in the initial public offering process, you're using the services of underwriters and their commitment to get your shares out there into the public. So, in summary, this is how an IPO and a direct public offering work.